Welcome back to FTfm. This week, the Chief Economist of the Bank of England called for a root and branch review of company law and corporate governance. With us to discuss the state of corporate governance globally is Howard Sherman, Head of Corporate Governance Business Development at MSCI. Howard,
Hello.
Is there a need to revisit the core concepts of corporate governance?
Well, first of all, I give the UK a lot of credit for undertaking this review in the first place. And in my eyes, and in the view of MSCI ESG research, the UK is generally a very well-governed market to begin with. But it's always worth taking another look to remain, at the top. Is it worth examining the core concepts again? I really don't think so. I think they remain the same as succession planning, integrity of your financial statements, tone at the top. All that will always remain core governance principles. What I think is really going on, though, is that the market has changed so much in the last few years that the role of the director has become much more challenging and complex. You've got cybersecurity just wasn't an issue a couple of years ago. Now it's a huge governance issue. Certain sectors, supply chain risk is dominant. The financial service sector, there are a huge amount of new rules and regs. Compliance issues now dominate the governance discussions. And what I think is really underpinning a lot of this is a growing tension between investors who have a very short-term interest and those who have a long-term interest. Some hedge funds, for example, on one side, and pension funds and sovereign wealth funds are the other end of the spectrum. Shareholders as a group are much more willing to speak up today, and that all presents a real difficult challenge for today's board. So I think the concept of short-term, long-term planning, which brings into it how does a board look at environmental, social, and governance factors, is worth examining, because I think they're real issues for a board today.
And are there measures that governments can take, legislation or regulation that can alter the balance between those long-term and short-term attentions?
Well, there's been some efforts recently in France and Italy to reward long-term investors by giving them extra voting rights. I think the motivation was genuine. I think they were trying to help companies, their boards, their management, focus more on long-term investing and long-term growth without the distraction of short-term pressure. I think the solution, providing extra voting rights, was wrong. I think there are much better ways to go about it. Extra dividends, for example, would be much more palatable to most shareholders. But short of that, I think it's really a matter for boards and their investors to really understand what is the long-term goal of the business and to engage with one another. I think is a much more effective way of ensuring that long-term interests will be protected than anything the government could probably do.
And are there global standards that all markets should aspire to, or is it horses for courses?
Well, I think obviously recognizing that board leadership is different than running the business on a day-to-day basis. Understanding why governance matters in the first place is a universal issue, which means the board should have its own leadership, either a separate chairman or an independent lead director. Transparency of financial statements, of course, is going to be true for every market. I happen to think that one share, one vote should be a universal standard, but in addition to the experiments in France and Italy, we've seen some high-tech companies come to market in the last decade with unequal voting rights for the founder. And that's worth looking at. Is that appropriate or not?
And not all of the standards that you talk about are met in the US, which is arguably the most developed market, in particular shareholder access and influence. Does that not imply that perhaps corporate governance isn't that important?
No. And I would argue that the United States is not the most developed market in terms of corporate governance. Shareholder rights in the U.S. are relatively weak compared to other markets. And I think we've seen enough financial debacles and governance and accounting scandals, going back to Enron and WorldCom, and more recently the financial crisis starting in 2008, that shows that there are some clear governance deficiencies in the U.S. market.
Okay, thank you very much, Howard. For more on this topic, please go to ft.com/FTfm.